earn, the higher you earn, the more the more tax you will pay. But however, if you have more deductions, then it will just be limited. So to get back to today's topic, we are going to be talking about incentives. So that one was just a highlighter to say, with tax, how does tax work? Why is it that you have to pay tax? If you're an individual, if you're a company, what are the things that you actually just need to take into account to look into so that you're aware? Do you have to register for PAYE as an employer? Do you have to register for that? So back to the topic for today, we're going to be talking about tax incentives. So tax incentives are their financial benefits from the government to promote specific activities. They are realized through things like deductions, credit, or exemptions. So the South Africa, the SARS, right? The South Africa Revenue Authority, it offers the incentives to boost economic growth, encourage specific sectors. You will see this when I speak about things like research and development, and also to boost sustainable practices through tax breaks and rebates. And also for job creation, also where I'm going to also dwell on employee tax incentives. Right. So the purpose of tax incentives is to drive economic growth and job creation and investment. I have already spoken about that. So tax incentives are crucial for business as they lower business costs. So they reduce some of the costs that the business is going to incur through tax. And then they also boost cash flows and also encourage adherence to the tax regulation. So the tax incentives, they promote sustainability as well by also motivating companies to adopt renewable energy, although I'm not going to talk about the solar incentive today, and also improve energy efficiency. Okay, all right. So the types of tax incentives that I'm going to speak about today, I'm going to speak about what we call turnover tax. I'm also going to dwell into SBC. I'm also going to speak about ETI and also speak about economic zones. I'll also touch a bit about research and development and how if you have invested in research and development, what are the deductions that you get? What are the capital allowances that you get from the machinery that you would have used to in the process of research and development that you would have done? Okay. All right. So this one is just to reiterate, to say deductions, they lower taxable income. Credits, they decrease the tax liability for immediate financial benefits. Exemptions also allow avoidance of taxes and specific income or assets. So the first bullet that I'm going to touch on is what we call turnover tax. So turnover tax, in summary, before I get into what is actually in the slides, but it might be the same because it's the same content anyway. Turnover tax is tax that you're paying tax on the actual turnover. So turnover is what we call if you're well versed with your income statement, turnover is before you do any deductions or before you have subtracted anything. Turnover is more in line with saying that more like your revenue or your sales, if I can put it in that way. So turnover tax is not a separate tax. But let's say you're a new business and you're getting into business for the first time, and then you anticipate to just say, okay, my turnover is going to be less than 1 million, then you qualify to register for turnover tax. And then with turnover tax, it also applies to micro businesses. Okay, that's small business, not small businesses, micro businesses, if I can say it that way. So to get back to the slides, turnover tax is optional for businesses with qualifying turnover. So when we say that it's optional, the onus rests on you as the owner of the business who is running a micro business, that you expect to say you're starting right now, but you also just want to be tax compliant, and you also trying to still find fit and determine how best you can sort out the record keeping aspect of everything, and also how best you can stay compliant without actually being a non-compliant citizen, if I can say it that way. So with turnover tax, now what happens is that you're only taxed on the turnover that you have generated in that particular period in time, but you have to register that you're actually going to be paying tax on turnover. And this applies for when, let's say, registered, and also you've just newly registered and you're just anticipating to say for the next 12 months, my turnover is going to be less than 1 million. And also, now the next question will be like, so what happens to the other tax type? Does it mean that if I only pay turnover tax, I also have to pay capital gains tax? I also have to pay things like dividend withhold, dividend tax, and the likes. So this one can get a bit technical, but I'm just going to try and make it as simple as possible. So what now happens is that when you determine to say 1 million, you're not taking into account, let's say when you sell a capital asset, right? That attracts what we call capital gains tax. I think we'll dwell on this maybe in one of the upcoming webinars where we are going to be talking about how capital gains tax works. But then in summary, capital gains tax, this is tax that is paid when you dispose a capital asset. So now let's say you are a micro, let me call it a micro business, which generates less than 1 million. And then now you dispose of an asset. When you dispose of an asset and receive money, we call it proceeds. Let's say in that particular period in time where you're still estimating that you get 1 million. So now what happens is that in an SBC or in a bigger company that generates more than 20 million, when you dispose of capital assets, you're subject to what we call capital gains tax. But now you're a micro business. What now happens is that 20%, it should be 20% of those proceeds. That is what is included in the turnover, now to actually get taxed. So how this now works is that you don't pay dividend, you don't pay capital gains tax, but a portion of those proceeds are included in you determining the tax that you're going to pay on the turnover. It's included as part of the turnover. I think I tried to make it as simple as possible to say a component of the proceeds that you have received from disposing an asset is included in the turnover, and it's used to calculate the amount of tax that you have to pay over a particular period of time. So the next thing about turnover tax is that, so now what is the process of actually registering for turnover tax? This can only be done in branch. You need to register for turnover tax when you go in branch, in a SARS branch to register, because it's a manual process which involves completing different types of documents. Okay, so all right, we have already spoken about how you register and in what period do you actually have to register. Okay, so that's turnover tax. So these are the rates for turnover tax. So let's say your turnover is less than 335,000 for the current year of assessment. You won't pay tax on that amount, but anything exceeding that, you have to pay tax at those rates that are put on that I have projected on the screen. So basically you would need to just also consult with a tax practitioner or someone who's well versed in tax so that you can understand to say, do you actually qualify for turnover tax? Because subject to different provisions, professional services are excluded from micro businesses. They're excluded from registering for turnover tax. People like accountants, people like lawyers, and the likes. Those are professional service providers. They're excluded from the definition of the people that can apply for turnover to be taxed using the turnover tax rates. So I think that was it on turnover tax. Okay, so with regards to turnover tax, the decision to register for turnover tax is solely on the taxpayer, and also where record keeping is too much expensive, and then it's too expensive, and then you also determine to say, okay, the current tax system, you're not well versed, and also the cost to hire a tax practitioner is expensive. Then it means that at this particular point in time where you're still trying to find fit, you can still register for a micro business for turnover tax to pay tax on the turnover that you would have registered in that particular year of assessment. Okay, so that was it on turnover tax. So the next topic that I'll speak on is with regards to a small business corporation. How do you qualify as an SBC? So if you earn not more than, if 20% of your revenue is not more than 20% of your revenue cannot be investment income. So let's say you're an SBC. An SBC basically is a company that earns income that is less than 20 million, right? But then, however, your revenue does 20% of revenue need not be from, it does not have to be from investment income, and 20% of income should not be from, let's say you're a personal service provider, then 20% of income should not be from rendering those services. So how do you qualify as an SBC? So all companies, they qualify as an SBC, which is a small business corporation, for as long as you're not a sole proprietor, you're not in a partnership, and you're not a trust, because those are taxed at different rates, and their tax determination, they are done differently. And also, with regards to shareholding, if you're a shareholder of an SBC, you need to maintain your shareholding for the entire year. If you're like, let's say you're a natural person like me, and then you're a shareholder of what we call an SBC, and then you need to be a shareholder of that SBC for an entire year. And also you need to ensure that you deregister from other CCs or companies before starting the new SBC. And also shareholders to have no interest in other companies, that is what I have said. And also your gross income should be less than 20 million per year. That's how you qualify to be an SBC. So with an SBC, what happens is that there are certain allowances that come with being an SBC. They are also taxed at lower rates compared to a business that earns more than 20 million, because as soon as you start earning more than 20 million, then it means you're also just being taxed at 27%, because that is the current rate that is being used for businesses that earn more than 20 million. But as an SBC, you're taxed on a sliding scale. I'll project the tax table so that you can see, to say by how much don't you pay tax if you have taxable income of this amount of money. If you have taxable amount of this amount of money, you're taxed on this rate and on this rate. So that is, in short, what we call an SBC, and that's how you qualify to be a small business corporation. So these are the SBC tax rates. So if you earn between 0 and if your taxable income, so remember with taxable income, taking you back to where I started, taxable income is when you say your income from the business less your expenditure, your qualifying your expenditure that is actually deductible for tax purposes, so that you determine what we call a taxable income. Just a point to note, accounting profit and taxable income are not always the same, because to go back, there's always income that might be included for SARS purposes, and it's not and it's not included. There's income that is included for accounting purposes, and it's not taxable for SARS purposes. And also there's expenses that you might incur. For example, things like your SARS interest and penalties, they are going to be expenditure when you determine your growth, your net profit. But now when you're not getting to your taxable income, they are not deductible. You are not allowed to deduct the SARS interest and penalties. So that's how you get to taxable income, trying to reconcile your accounting profit and for it to actually meet with the tax aspect of it. So these are the SBC rates, and the rates at which taxes are paid when you're registered, when you're in SBC, right? So this is just the tax rate. So the tax rate just changed from 28% to 27%, which is now what we are using. We are using 27% if you're a business that earns more than 20 million. Okay. So for example, just for clarity purposes, it's just an example to show what happens, to say if you're an SBC, if you're a sole prop, if you're a company, how exactly are you actually taxed? So I'm going to touch on sole proprietor just a bit, but I'm not going to get into detail. With the sole proprietor now, your income that you derive from a sole proprietor is taxed in your individual capacity. Hence, they're including the component of rebates there, because if you're a sole proprietor, let's say you're a sole proprietor, all the income that you earn, the net profit, if I can put it that way, is taxed in your individual capacity as a person. If you're a company, you're taxed at 27%. Kindly ignore the 28% because that's a previous rate. So refer to the above where we indicated the 27%. Now, if you're also an SBC, if you're an SBC, you're taxed at those rates that I indicated, that are sliding scale to say if you have exceeded 90,000, if you're 90,000, I think it's 90,000, between 90,000, 95,750, anything above and beyond is taxed. So which means that is the amount that you pay. And then with turnover tax, that's also a lower tax rate that you're actually going to pay. So in short, this slide was basically just trying to indicate to say, before, if you're a micro business, if you're an SVC, if you're a company earning more than 20 million, if you're a sole prop, you're basically being taxed at different tax rates. So that is the point that I was just trying to drive home with the slide, with this example slide. So now let's talk more about SBCs and the incentive that is available for SBC. So you would see that in terms of the South African regulation, right? A tax incentive for small business is to encourage, if the tax incentive that is there for small business is to encourage growth and investment in small businesses. Okay, so the first step that you need to follow is to ensure that your business actually meets the criteria to be recognized as an SBC, which you can do using those pointers that I've made available to you. Otherwise, you can give us a call and then we can consult and we help you determine to actually say at this point, are you an SBC or you actually have to pay tax at 27% or you're actually a micro business. So with a small business, the incentive that is there is there's a legislation that is in the tax legislation. Okay, there is a section, and sorry about that. There is a section in the tax legislation that is section 12E. So section 12E it indicates that let's say that you have an asset that is used in the process of manufacturing. 100% of the cost is going to be allowed as a deduction for tax purposes in that particular period of time. Also, with section 11E, there's a provision to say, let's say it's not plant and machinery used in the process of manufacture, it's just utensils or other machinery that are not being used for that sole purpose. You qualify for two. So you would see that getting into detail with allowances, there are things like wear and tear that you might qualify for. Wear and tear comes at a different rate. It comes at different rates depending on the type of depending on the type of asset. But however, now with section 12E, which qualifies for small businesses, is either you apply those allowances that are applicable to the type of asset that you would have purchased, or you can qualify, you can use 50, 30, 20. So what 50, 30, 20 means is that in 3 years, you can claim an allowance using 50% for the first year, 30% for the second year, and 20% for the third year. So in summary, what I'm just trying to say is that as an SBC, if you have purchased a plant or a machinery that is being used in the process of manufacture, you can qualify for 100% allowance. Or let's say you have purchased another asset, but it qualifies for different allowances. It's either you can apply the applicable regulation that you would want. For example, I have used the example of wear and tear, or you can use 50, 30, 20, which means that 50% allowance in this year, 30% allowance in next year, 20% allowance in the third year. Allowance basically means that is the portion that is going to be. So isn't with income tax, you have your income, you have your deduction, you have your allowances that are going to be trying to reduce the taxable income so that your tax liability is lower at the end of the day. So that's how section 12E works. And then, yeah, so this one is just the tax rates that are being explained there. Okay. All right. So our next incentive that we are going to talk about, what we call employment tax incentive. So employment tax incentive is available to employers. It was mainly done so that it encourages employers to hire younger people between the ages of between 19 and 29, if I'm not mistaken, of the age range, but somewhere along those lines, where where young people qualify. So, but I know that the last age is 29. So between 19, 18 to 29. If you hire individuals that are within that age range, you qualify for what we call employment tax incentive. Kindly note that I said employment tax incentive is for employers, not the employees. So it was implemented on 1 January 2014, and also the government has indicated that it will only run up until the 28th of February 2029. So with this one now, the problem that we experience with most of the clients that we deal with is that they are not aware that this incentive is available to them, because mainly because maybe they have not had it has not been communicated to them that it's there, and also maybe because of lack of knowledge in that regard of some of the incentives that are available to different individuals. So the incentive, the ETI incentive now, it has different rates that are applicable to it, but I don't want to say the detriment or the downside of the ETI, but I can just say maybe the disadvantage of the employment tax incentive is that you can't employ your relative between those age ranges because you don't qualify to be able to claim back the ETI. If it's someone connected to you, because it's more like you can just say to your relative, come and work for me, and then I'll pay you so that I can claim back then I'll pay you a salary within the range, and then I'll claim back from SARS. So that happens. So it's more like an anti-avoidance thing to avoid people just employing their relatives so that they can benefit from the exercise. So if someone is your relative or a connected person in some way, a connected person can be, depending on the relationship that you have with the person, that is according to the SARS legislation, is a connected person. That is what we call a connected person, like a relative, your child, okay, your child, yeah, but people within the same, if I can call it, within the same, let's say, range as you are, that are your relatives. They are connected persons in terms of an individual person. So now with ETI as well, the downside of it is that also, if let's say you have employed someone in this year, you qualify for that employment tax incentive as an employer, and then next year you still have that person. The employment tax incentive does not increase; it actually decreases the more that person stays. But it doesn't mean that you have to hire and fire so that you qualify for the ETI. But it's also going to be a red flag in terms of SARS if you're hiring only for the purposes of actually utilizing the employment tax incentive. So these are the how you determine to say how much ETI are you actually going to qualify for. So how employment tax incentive works is just that remember when I spoke about PAYE, those are taxes that are withheld by the employer to pay to SARS on behalf of the employee. So now ETI now comes by reducing that liability that you would have been paying, which means that has a financial impact on your business. If you're supposed to pay, let's say 10,000, and then your ETI is around 2,000, then it means that the portion that you have to pay is the 8,000 difference that is there. So your ETI basically reduces the tax liability that you have to pay as far as PAYE is concerned. Okay, so as I was mentioning, to say that the more the person stays for more than 12 months, then your ETI reduces that you can utilize over a particular period of time. So that was it on employment tax incentive. Yeah, okay, so I spoke about the rates, I spoke about qualification, and then, yeah. So let's say mainly if let's say you employ someone up until between 19 and 29 years of age, their remuneration does not need to exceed 6,500. And also just a point to note that the ETI does not apply. Let's say you have your domestic helper, ETI does not apply to you as the employer. So those are some of the reducing, those are some of the things that can actually eliminate other individuals from being eligible to utilize the ETI incentive. Also, in that same light, with regards to ETI, okay, so I spoke about reduction in the PAYE, okay, and then the periods. Okay, so I think I'm done with speaking about employment tax incentives. So now the next incentive, before we get to the last incentive that we'll speak about, is the special economic zones incentive. So economic zones are designated areas within a country that have different economic regulations compared to other regions. So mainly, if you're in the special economic zone, you have a reduced income tax rate, and also you qualify for an accelerated depreciation allowance of 10% on the cost of any new or unused building or improvement owned by the qualifying company. So when you say accelerated, it means that it's an increased rate in you claiming the allowance with regards to a special economic zone. So the special economic zones, for you to qualify for the special economic zone incentive, you need to be carrying on a business in the special economic zone, and at least 90% of your income should be derived from carrying on a business in that zone as well. And then not more than 20% of deductible expenses should be incurred, and not more than 20% of the income received or accrued to the company are from transactions with connected persons. So it goes back to the aspect of connected persons. So I think this one is mainly touched when you speak about capital gains tax or tax in general. With regards to connected persons, how SARS works is that if you're a connected person, there's a higher likelihood that there will be more like a tax evasion, if I can say it that way, where you are trying to avoid tax. Because if I'm related to someone, we can say, let's just do this, and then we capitalize on this allowance. So if your 20% of your income is being received from a connected person, then you are not eligible to qualify for the special economic zone incentive. Okay, so the other thing with the special economic zone, with the special economic zone incentive, is that you just enjoy a reduced corporate income tax. I would think that the rate should be 15%, if I'm not mistaken, but it's not 27%. It's a reduced rate. And then also the accelerated depreciation, it means that, let's say you have a new building, or you have done an improvement in a special economic zone area, 10% of that cost is going to be claimed as a deduction in the first period in which you have done that improvement, or you have erected the new building. Okay, so that's special economic zone incentive. Okay, so the last one that I'm going to speak about is research and development. So this one is a tax incentive that is available. Let's say you're a company that is conducting research and development. You qualify for an accelerated allowance for capital expenditure, and you also get a deduction. So I'm going to speak about that part after I've just given you a rundown of what happens with research and development. So the research and development activities must involve things like your innovative research, development of new products or processes, or technological advancement. So the research and development activities must also be approved by the Department of Science and Innovation. So now, let's say you are doing research and development, and then it has been approved that it's research and development, it qualifies by the Department of Science and Innovation. Then from a tax component, what do you enjoy? If you have incurred expenditure towards that research and development, 150% you're allowed 150% deduction on the expenditure that you would have incurred. And also, let's say you have purchased a capital asset that is being used in the process of research and development. It means that you can claim an allowance at the rate of 50, 30, 20. Remember how 50, 30, 20 works? 50 this year as an allowance, 30 next year, and 20 in the third year. For plant and machinery that you would have purchased, when you purchase an asset, I think I have mentioned that when you purchase an asset, you qualify for what? A capital asset. You qualify for what we call allowances. There are different allowances that you qualify for depending on the nature of assets that you would have purchased. So to qualify, I think I have mentioned that you also need to be approved by the DSI, also by the National Treasury and SARS. Still, if SARS is approved to say that, no, this research and development costs, they qualify to be deducted, or you qualify to have an allowance, they can still come back and say you need to prove that these are qualifying research and development costs. Because remember, with tax, the burden of proof to prove that this is deductible, this is not deductible, it lies within the taxpayer, regardless of what processes might have been followed. So qualifying expenditure for research and development undertaken, they include things like materials, equipment, salaries, and if you incur any expense that is directly related to the research and development process. So that's the other incentive. That's the last incentive that I wanted to speak about today. Okay. So in summary, these are the things that we have spoken about. We have spoken about micro businesses and how they can tax their clients, micro businesses, and how they can be taxed using their turnover and the qualifications, who qualifies for it, being a person who is earning less than 1 million, or you anticipate to earn less than 1 million, and your business is still in the growth phase, but you still also want to remain tax compliant and also get your tax clearance. We also spoke about SBC, which is a business that is earning less than 20 million, and the qualifying criteria. We also spoke about Section 12E, which is under the small businesses, where I alluded that if you purchase plant and machinery that is used in the process of manufacture, you qualify for what we say 100% allowance. Otherwise, if you purchase any other capital assets, you can either apply the applicable allowances to that assets, or you use 50, 30, 20. We also spoke about ETI. We also spoke about special economic zones. And then we lastly spoke about research and development, where you can qualify for the 150% deduction. And also, if you have purchased an asset that is directly used in the research and development process, then you qualify for allowances at 50, 30, 20. Okay, so in conclusion, by understanding and utilizing these tax incentives, you can benefit from substantial financial advantages while contributing to environmental sustainability, business growth, and innovation. Because as you utilize some of the allowances that are there, you're saving on one component, which means that the saved component can be utilized in other business aspects, things like growth or any other cash flow activities that will have that will allow to improve the business's sustainability. So that is what I wanted to speak about today. If you have any questions, we'll be having a brief Q&A session, Russ, right now. Okay. Okay, so whilst we wait for the poll, whilst we wait for everyone to vote, I think that's it from my side. I'll hand over to the host. Thank you.
Thank you so much. Now we're gonna go to the next. We just want to give you information on the whilst we are waiting for everyone, whilst they're still doing. We can continue, and then we're gonna give you highlights on our next webinar that you need to be looking out for, which is understanding financial statements. And how to leverage them in your business. It's also happening at the same time from 10 a.m. to 11 a.m., 11 October. So you can also put this in your diaries. And also, you also need, for more services in the things that you have learned here on tax incentives, if there's anything further that you require, you can also contact us at Brainmore on this number, which is 011 026 3082. You can, or you can just take, if you have your phone, you can just take a picture, but you can also, you can take down also the cell number 083 246 5905. And we are looking forward for you to be able to be watching also our next webinar. I'm sure everyone has, yes, if there are any questions, we are still waiting for questions. Thank you so much, Kuto. You saw this information very informative. We are very grateful that you were able to, of helpful to you, and you can contact us anytime. Okay, thank you everyone that you have joined us. If you don't have any questions, but you still can go on our, we'll also give you more further information. Everyone who's on our contact list that managed to register, we'll also forward to you this webinar as well as our contact details. Thank you.